All right, what is up, everybody? So today's video is going to be a really good one, and I made this picture here, this kind of like a meme. I think it really summarizes it very well. The debt ceiling deal is going to flood the market with up to 1 trillion in treasuries, right? And so here's the markets right here, and this massive amount of treasuries coming and hitting the market currently as we even speak. So we're going to break this down. I got a really good comment, asking, well, what does this do to the market, right? When I posted about this article here, speaking of the bond market prepping for the T-bill deluge after the debt ceiling deal. And so what we're going to do is we're going to go into the article, explain what they talked about, all right? And then I'm actually going to really just give you guys a good breakdown of the different areas that this is going to affect the markets. Okay, so we're going to go all through them. It's broken down into 5 categories, and we're going to summarize that very nicely for you guys, so that way you guys can have a much better understanding and really understand, what potentially is coming to the markets and what we could see. All right. So make sure to smash that like button, subscribe to the channel if you guys are new. With a debt ceiling deal signed, sealed, and delivered, it's time for Uncle Sam to refill its bank account. Now, why does this matter? All right. Well, it's another example of the chaos caused by the months-long impasse. The U.S. government's well-oiled borrowing machine was screeched to a halt in January, is now playing catch-up, and the incoming deluge could strain the system. Whether it will morph from a mere challenge into a broader market disruption is a hotly debated topic right now, especially with the economy slowing and the banking sector still vulnerable amid its own simmering crisis. The government will likely need to issue as much as $1 trillion in treasury bills over the next 6 months to return the balance to historical norms, plus continue funding day-to-day needs. Now, on the big picture, outside of a major crisis like 2008 or 2020, this is going to be the largest issuance of T-bills on record. It's kind of like watching a person walk across a tightrope, says Jim Caron, and the tightrope is not without risk, but the walker believes the risks are knowable and can be managed. Now, the chief among those risks, all right, the new bills could siphon more money out of a banking system already damaged by mass outflows this year. That could send banks scrambling to raise more cash, pushing up their funding costs and further stressing the system, Goldberg says. Now, what they're saying is that some think the fears are overblown. Putting half a trillion or more of bills into the system might sound terrible until you realize that there's an extra couple trillion sloshing around out there anyhow that can't find a home, and that ends up in the Fed overnight. Now, this whole statement, all right, in that whole article basically suggests a significant increase in the supply of treasury bills in the market. And this increased supply has several potential implications for bond prices and bond ETFs. Now, here's how. Number 1 is going to be price pressure. 2 is going to be the yield impact. 3 is going to be bond ETFs. 4 is going to be interest rates, and 5 is going to be inflation expectations. So we're going to break all of those down for you guys, starting off with price pressure. All right. Now, when there's a surge in the supply of any product, including bonds, the price can be affected if the demand doesn't keep pace with the increased supply. In this case, the increase in the supply of treasury bills may lead to lower prices to attract enough buyers. Now, I did a really good video, that you guys should watch, explaining how, a lot of people right now that are actually in treasuries or in T-bills, they're having a little bit of FOMO right now, okay? Because what they thought was a really amazing return of 5% risk-free, they're seeing the stock market is exploding, and, they could have gotten 20, 30%. All right. So, will there be that huge amount of demand in the future, as these T-bills and these new treasuries are hitting the market up to $1 trillion worth, and a lot of those 6-month and 3-month T-bills are coming to maturity? Are people going to continue buying those, or are they going to try to put that money back into the equity market? Now, the next is going to be the yield impact, right? That's going to be the next case where this is going to be affected. Right, so bond prices and yields have an inverse relationship. When bond prices fall due to increased supply, the yields on those bonds rise. This could mean that the new treasury bills might offer higher yields than existing ones, making them more attractive to investors. So, as we talked about the price pressure, and it could cause the bonds to go down, that's going to result in higher yields, right? The higher yields make them more attractive, and that lowers the actual price of the bond. Right now, bond ETFs are also going to be affected in this. These are going to be things like TLT, for instance. That's one example. That's one of the most popular bond ETFs. And bond ETFs that hold treasury bills could also be affected. Firstly, if they hold existing treasury bonds, the value of their holdings could fall if bond prices drop. And secondly, if the yields on new bonds are higher, the ETF might underperform relative to these new bonds unless they adjust their holdings. Okay, so that's how, TLT could possibly be affected. Combining all of these things that we're going over in this video, that comment that I got was really like, okay, well, what does this do for TLT? Does it make it go up? Does it make it go down? Hopefully this video gives you guys a little bit of a better understanding. Now, of course, interest rates are going to be one of the other factors here, right? And if the government has to offer higher yields on its new treasury bills to attract enough buyers, this can push up interest rates in the wider economy, as other borrowers need to offer competitive rates. Higher interest rates can depress bond prices further and can also impact sectors of the economy sensitive to interest rates, like housing or utilities, which could indirectly affect bond ETFs that include corporate bonds from these sectors, right? So think of, some of your different bond ETFs you have out there. You have JNK, you have the junk bond ETF, you have HYG, you have the high yield corporate bond ETF. You have LQD or LDQ. I can't remember the exact ticker, but there is lots of other bond ETFs besides just TLT. Right now, inflation expectations is going to be the last one, right? And the increased borrowing could also impact inflation expectations. If markets think this increased borrowing might lead to future inflation, that could push yields higher and bond prices lower, as investors demand a higher yield to compensate for the potential erosion of their purchasing power due to inflation. Now, inflation has been a very hot topic throughout all of 2022 and still now in 2023. We are seeing a lot of inflation dropping. And we're starting to get those signs. We're starting to see CPI coming down, but there is the chance that inflation expectations could start to rise due to this massive amount of money hitting the treasury market. So please note that these are potential effects, and the actual outcome depends on a host of other factors, including the overall economic environment, monetary policy, and global economic factors. Also, bond market investors include many large institutional investors who base their decisions on a wide range of factors, not just supply and demand considerations. So, supply and demand is one part of it, all right, but as we just discussed, there's global economic factors, you have the overall economic environment, the monetary policy, lots of different things go into the decisions that these investors are making in the bond market. The bond market is not so much of retail compared to the stock market. There's a lot more of retail in the stock market, but the bond market is much larger than the stock market. Okay. And that's where really, a lot of people look to the bond market for guidance. And they say that the bond market, is a much better, kind of not even predictor, but just overall view of where the economy is. And the reason being is some of the things that I just stated in the statement right here. So that's it for today's video. Hopefully you guys enjoyed it. Smash that like button, subscribe to the channel, and I'm out.